You're about to discover where most people will never know about how to use their 401k retirement money to invest in commercial real estate. In the traditional sense, most people think of, when they think of using their retirement money for investing in real estate, they think of three things. You have three options basically. The first option, and the most common option, is to use maybe a self-directed IRA, solo 401k, right? These types of accounts are used quite often. Now let's say you want to purchase an apartment building, a self-storage facility, or an office building, right? You can use this, but the big but, and the but is big, you don't own the property, okay? So the property is owned by these accounts, which means there's lots of restrictions, meaning that you cannot use the money produced from your commercial real estate to buy groceries, to pay for personal expenses, to write your kids' tuition check, to take vacations. You can't. All the money has to stay in here. Okay. Option number two is you can liquidate or cash out your retirement account and pay the penalties. Right. You have to pay the penalties for it, and you also have to pay regular income taxes, because when you cash it out, it's considered earned income. You have to pay income taxes on it. Okay. From a traditional sense, again, a financial advisor, a commissioned one, will say that's a no-no. Okay. And number three, option three, is to do nothing. Is continue doing what you're doing with your retirement account. Maybe invest in some commercial real estate related index funds or something. But how is this working for you, right? This is the reason why I'm doing this video. So next, what I want to do is show you how to use your 401k retirement money to create cash flow, to create a nice retirement account, and to create wealth, right? While you are owning the property. Again, using your retirement funds. Let me show you how. Option two is what people never really consider, right? When investing in commercial real estate using their retirement account. Option two, if you recall, is to liquidate or cash out your retirement account. Peter, why in the world would I do that? You're crazy, right? Why would I do that? Look at the cons. So if you get out, you're going to have to pay a penalty of 10% or more on the money that you take out. You're going to have to pay regular income taxes on all the money you just received. You no longer have a retirement vehicle, and it's frowned upon by the traditional financial advisors, right? It really is, right? But for me, a real estate guy, look at the pros, okay? So I'm going to liquidate, take the money out. I'm going to buy commercial estate. I'm going to buy an apartment building, and I have full control over the money, okay? Now, when I had my money in the retirement account, I didn't have full control, right? So if a stock went down, it went down. Nothing I can do about it. I didn't have insurance, right? Next is you'll own the property. If you were to purchase your apartment building, use a retirement account, you don't own the property, they do. So now you'll own the property, and there are a gazillion reasons why you want to own the property. Next is the cash flow generated from buying your commercial property, from buying an apartment building, you can use today, and you can use it now without penalty. You can write yourself a check, you can take a vacation, you can buy a car, you can give it to charities, you can pay your son's or your daughter's college tuition. Lastly, this is controversial. If you were to cash out, one of the pros is it may actually help you reduce taxes. Poof. What do you mean by that, Peter? Well, let me share with you what I've done and what our students are doing today to actually help reduce their taxes by cashing out their retirement. Let's do that next. As I promised, here is a solution. All right. So here are the cons here, right? So we have all the cons here of liquidating, cashing out our retirement fund. Here's a solution, okay? Solution is to figure out a way to offset all the penalties and taxes you're going to pay, right? So we can do that with commercial real estate, okay? All right. Number two is to liquidate your account as early as possible. So do it now so that we have the full benefit of the entire year, so we can maximize all of our tax savings, okay? Number three is, this is the key, buy as large of a commercial property as you can with your funds and leverage as much as you can so that we can maximize and optimize all of your tax savings with a good real estate accountant, okay? And fourth, this is really important, okay? This is how you're gonna wipe away everything here, is to perform a cost segregation study on your property, okay? Cost segregation, the video will appear on the screen. I did a video on that, how that works. It's one of the greatest ways to create tax benefits to maximize the depreciation. It actually accelerates the depreciation of your property that can literally maybe triple or quadruple what you usually get on a commercial property in terms of tax savings. Check out the video, it's very powerful, okay? 1, 2, 3, 4 wipes away all the cons here. All right, now, next, what I'm going to do is take you to an example. Let's go there next. All right, here is a 3-step example. See if you can follow me here, okay? All right, so again, I have, I'm cashing out or liquidating a 401k or retirement account, right? So first I'm going to make an assumption that you or your spouse are a real estate professional, okay? Classified by the IRS. That's important here to maximize all of these deductions, okay? All right, so let's say your retirement account has $350,000 in it. You saved it for 35 years and that's what you have in there, and that's all you have, okay? All right, and you're wondering, how can I retire, right, with only $350,000 and it's been 30 years? All right, so what you're going to do is you're going to liquidate about half of it. So you're going to take out 170,000 of the 350. So we're not cashing in the whole thing, okay? So you're going to pay your 10% penalty of 17,000. You got to pay your income taxes about 25,000, okay? So your total hit to taking out 170 is 42,500. Ouch! Is that worth it? Is that worth doing, right? To have to write a check to Uncle Sam for 42,000 by liquidating 170. Let me show you that it is. All right. So what you're going to do, step 2, you're going to buy a 6-unit apartment building someplace in the Midwest for $450,000, $75,000, $80 a door. It's doable. Okay. Your down payment is going to be 25%. Okay, which is $112,000. You add in closing costs, the loan and all that, right? So your total out of pocket with your down payment, closing costs, appraisal, all that stuff, you need $125,000, okay? You're pulling out 170. So you do have enough, all right? And by the way, you're cash flowing on this 6-unit property about $1,000 a month or $12,000 a year. Not a whole lot, but there's some there, okay? I want to be conservative here. All right, now, okay, so let's go to step 3. Step 3, as I mentioned before, you're going to perform a cost segregation study, which is an accelerated depreciation schedule on your property where you can write off things much quicker. Rather than over 27.5 years, you can write them over year 1, year 5, year 15, but the savings is going to be about $67,000 immediate, okay? Immediate. That's the beauty of commercial real estate when doing a cost set. You can realize a tax deduction of $67,000 the moment you own the property. Okay, so that's a beautiful thing. Again, I have a video that will appear on the screen again that breaks down how cost segs work. They're awesome. Okay, all right. Now we have this liability here at the end of the tax year to pay Uncle Sam. Guess what? We have an immediate $67,000 in tax deductions. We can wipe out this 42.5 by applying the $67,000. Okay, so $67,000 tax deductions by your 42.5 here, you have $24,500 left over, right? After you take care of the taxes and penalties, you have this much in tax deductions remaining. Okay, what you can do is, remember, you have $12,000 that you're pocketing in your pocket every year. You can take out of that 24 left over, you can now wipe out that year of cash flow, right? Because you have the 24 left over. Guess what? This gets even better, right? Next year, year 2, you're going to have another $12,000 a year in cash flow. You also have left over another $12,500 of tax benefits that you can write off year 2. All right. So cost segs, you can take the benefits into the next year. Okay, so you not only have 1 year of paying Uncle Sam no taxes on your cash flow, you can have the future years as well, so long as you have remaining tax benefits. One thing that I didn't leave, that I left out here, right, because I have no room on my board here, is that you have other tax benefits. You can write off the mortgage interest. You can write off your home office. You can write off your trips to the property. You can write off your airline tickets. You can write off if you use a car to run this business. You can write off all of that, your repairs, all of that. So you can actually make this even greater. Again, the beauty of commercial real estate. So instead of having this $12,500, this can be, this can be quadrupled if you add everything all together. Okay? So now, the original question was, should I have cashed in my IRA to do this deal? The answer is yes, in my opinion, if you know what you're doing. Okay? All right. So here are the benefits. So not only are you making $12,000 a year on this property, right? You have successfully offset the penalties and the taxes here. Okay? You're paying down your loan balance every year. Every month you pay your mortgage, you are paying down the loan balance. You're creating equity, right? A bonus could be here. What if your rents could go up every year, right? You're creating more NOI. You're forcing the appreciation. So you can do that as well if that's available. You have all these benefits here. So let me ask you a question. I want you to answer this question, yes or no. Okay. Here's the question. Okay. All right. So we used 170 of 350. The question is, considering what you just learned here, would you consider taking out the additional money to do another deal? Would you? So please, in your comment box, give me a yes or no, because I'm thinking about doing a part 2 to this video, and based upon your answer. So please tell me if your answer is yes or no. Yes, if you would take the remaining money left over and do this again, or would you not? Okay, let me know. All right. So thanks everyone. Thanks for hanging out with me. I know this can get quite complicated, but we are the experts. So this is not complicated to us. We do this every day, and so do our students. All right. So if you'd like to learn more about us and what we do for our students, go ahead and apply to be one of our proteges. If not, go ahead. There's a link there for my book, Commercial Real Estate for Beginners. That link will appear. Just click on it and just read all you want. All right. Do me a favor. Go ahead and like this video. Subscribe to our channel to keep us #1 in this space. Thank you, everyone. You have a great day, and I'll see you at the next video.